Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing language of corporate finance. And today we're diving into Figma's latest financial filings. And let me tell you, things have been interesting, especially after that big tech merger drama everyone was talking about. This report is essentially a checkup on how they're doing financially and what they tell us about their future. And hey, if you appreciate getting straight insights from these dense documents, make sure you're subscribed and consider joining our Discord community, linked in the description below, for even more direct access and discussion. Alright, first things first, let's talk about who filed this report and what it means. This is Figma, the design tool that's become pretty essential for many of us building digital things. They've filed their quarterly report, which gives us a snapshot of their financial health. Let's jump straight into the numbers because that's where the real story lies. In their condensed consolidated balance sheets, we see a significant increase in cash and cash equivalents. As of June 30, 2025, they had $621,619 compared to $4,000 at the end of last year. That's a healthy jump, suggesting they're managing their cash well. Then there's the digital assets line showing $34,000 at the end of last year. That's a healthy jump, suggesting they're managing their cash well. Then there's the digital assets line showing $30,000 and $90,000. Looking at total assets, they've grown from $1,793,148,000 at the end of 2024 to $2,034,663,000 by mid-$2,663,000 by mid-2025. That's solid growth, showing the company is expanding its asset base. On the liability side, accounts payable saw a jump from $4,163,000 to $12,029,000. This could mean they're buying more from suppliers, which is often tied to growth. Accrued compensation and benefits also more than doubled from $19,377,000 to $39,000, which makes sense as they're likely hiring more people to support their expansion. Total liabilities increased from $469,095,000 to $607,449,000 overall. And then there's stockholders' equity, which is the ownership stake. It grew from $1,324,053,000 to $1,414,000. This increase is a good sign, reflecting retained earnings and overall growth in the company's net worth. Now let's look at how they're making money and what it costs them. This is the condensed consolidated statements of operations. Revenue really jumped here for the 3 months ending June 30, 2025. Revenue was $249,640,000, a significant increase from $77,198,000 in the same period last year. That's a 41% increase, which is pretty impressive and driven by more customers, especially those spending over 10 more customers, especially those spending over $100,000 annually. What's really interesting is the cost of revenue. It actually dropped from $39,588,000 to $27,899,000. This is a big deal because it means they're becoming more efficient at delivering their services. A big part of that drop comes from stock-based compensation expenses, especially tied to that big RSU release event we saw in May 2024. Because their revenue grew and their cost of delivering that revenue dropped, their gross profit significantly improved. It jumped from $137,640,000 to $221,000. This is a testament to their improved efficiency and revenue growth. Now, operating expenses are where things get a bit wild, mainly because of that one-time event. Research and development expenses plummeted from a massive $553,676,000 to $83,052,000. This huge drop is directly linked to that May 2024 restricted stock unit release, which caused a massive spike in stock-based compensation expenses last year. Without that one-time event, their R&D spending is still likely increasing as they invest in things like AI, but this comparison really highlights the impact of that specific event. Sales and marketing expenses followed a similar pattern, dropping from $276,246,000 to $97,701,000, again largely due to the absence of that heavy stock-based compensation expense from the RSU release event. And general and administrative expenses also saw a massive decrease from $220,000 to $38,022,000 for the same reasons. Because of these shifts, income from operations went from a huge loss of $894,287,000 last year to a profit of $2,076,000 this period. This is a massive turnaround, even though the operating profit itself is still small. It shows they're moving in the right direction operationally. Other income net saw a big increase to $36,900 and at $78,000 from just $10,139,000. This is largely due to gains from their investments, especially that Bitcoin exchange traded fund they mentioned. All of this led to a net income of $28,227,000, a dramatic improvement from the net loss of $27,854,000 last year. This is a huge win, showing they've turned a corner operationally. Let's check the cash flow statement. This tells us where the actual cash is coming from and going. For the 6 months ending June 30, 2025, cash provided by operating activities was $152,000. This is a huge change from the $96,382,000 used in the same period last year. They've gone from burning a lot of cash to generating it from their core business. Cash used in investing activities was $33,575,000. This was mainly for buying marketable securities and some cash paid for business combinations, essentially to acquire other companies. Financing activities provided $15,784,000, mainly from stock options being exercised. Overall, their cash balance increased by a healthy $141,000 in the first half of 2025. Now, let's look at those notes. They give us the context behind the numbers. This section on digital assets is new and important. They're holding USDC, a stablecoin, and carrying it at fair value. This shows they're embracing digital assets. They also mention customer concentration risk. It says one customer accounted for 14% of their accounts receivable as of June 30, 2025. While not alarmingly high, it's something to keep an eye on. They also state that no single country outside the US accounted for more than 10% of long-lived assets or revenue, suggesting a diversified international presence. Figma entered into a new credit agreement for a revolving credit facility of up to $500 million. This is a significant line of credit, giving them financial flexibility. As of June 30, 2025, they hadn't drawn on it, but its availability is a positive sign. In April 2025, they made an asset purchase of a technology company focused on AI for $14 million. This acquisition includes goodwill of $9.2 million, showing they're investing in AI capabilities as they promised in their overall strategy. The goodwill number increased significantly due to these acquisitions, from $11,398,000 to $24,000. This indicates active growth through acquiring other businesses to enhance their platform. In their equity incentive plans, it's noted that they approved a significant increase in shares reserved for their 2012 plan and launched a new 2025 equity incentive plan. This is typical for growing tech companies looking to retain talent. The CEO Equity Awards are quite substantial. The 2021 CEO Market Award and 2025 CEO Stock Price Award have performance-based vesting conditions tied to market capitalization. This means the CEO's incentives are directly aligned with increasing the company's value, which is a good sign for shareholders. Earnings per share is still a bit quirky. For the 3 months ending June 30, 2025, diluted earnings per share is reported as 0, despite a net income. This is likely due to how they calculate it with different stock classes and preferred securities common in startups. However, the trend is hugely positive compared to last year's negative earnings per share. Let's talk about the risks. They've got a lot of them, which is normal for a growing tech company. A major one is their rapid growth potentially slowing down and making it hard to manage. They also highlight the intense competition, especially with AI evolving quickly, and their reliance on AI in their products could bring legal and reputational risks. Another big factor is the multi-class stock structure, which concentrates voting power with their CEO Dylan Field. This means a few key people have a lot of control. This is a recurring phrase in the risk factors, and it's a standard warning, but it underscores that a lot can go wrong. They're really emphasizing the impact of AI on the industry and their own business, noting that AI investments might hurt their short-term profit margins. They also explicitly mention concerns about security breaches, which is a big deal when you handle so much user data. This statement about not paying dividends means they're reinvesting everything back into the company for growth, which is typical for a company that's just gone public or is planning to. So don't expect any dividend payouts anytime soon. They also warn that the stock price could be volatile. This is pretty standard advice after an IPO, especially for a growth-oriented tech company. It's important to note they are an emerging growth company. This means they get some reporting breaks, which could make them less attractive to some investors who prefer more transparency. But it also means they're still in that early high growth phase. A significant risk they highlight is their reliance on third parties like Amazon Web Services for hosting. Any disruption there could seriously impact their operations. In my opinion, Figma is on a strong growth trajectory, as evidenced by the revenue increase and the shift to profitability. Their investment in AI and new products like Figma Sites and Figma Make shows their forward thinking and trying to stay ahead of the curve. However, the heavy reliance on stock-based compensation, especially around that RSU release, makes year-over-year comparisons a bit tricky for understanding their core operational health. The concentration of voting power is a notable governance risk for investors. Their diversification, both product-wise and geographically, seems solid, but you always have to watch those big customers and the ever-present threat of security breaches. Overall, Figma is in an exciting but challenging phase. They're growing fast, innovating with AI, and have a strong financial cushion after the IPO, but they need to manage the complexities of that growth and the risks associated with cutting-edge technology. Alright, that's our breakdown of Figma's latest filing. What's your take on these numbers and what they signal for the company's future, especially with all the new AI products they're rolling out? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and make sure you subscribe for more deep dives like this. And don't forget to check out our Discord community, linked in the description, for more direct insights and discussions. Thanks for watching. See you next time.